When most people picture how the wealthy invest, they imagine secrets, maybe some whispered stock tip or a hedge fund with a mysterious name, maybe even a deal scribbled on the back of a cocktail napkin somewhere over the Atlantic. But after 31 years of sitting with families worth $5 million, $10 million, even $50 million and more, I can tell you that picture isn't reality. It actually looks nothing like what you read about online. It's not glamorous, it's not mysterious, it's practical, it's intentional, and when it's done right, it's powerful. And so today I want to show you 3 principles I see again and again with families who've truly made it. They're not theories, they're not cliches, but they're actually patterns that separate wealth that's fragile from wealth that lasts. I'm going to be very specific. The names are changed, but I'm going to provide real numbers, real problems, and real solutions. Because at this level, the details matter more than the generalizations. And so the first principle is you want to have purpose before products. If you want to understand how someone thinks about their money, listen to this first question. Most investors say, "What should I buy?" The folks that have had success, they actually ask, "What do I want this money to do for me and my family?" You see, that small shift, it changes the entire conversation. And I learned this years ago with Tom and Sarah. They'd built a $40 million manufacturing company from scratch. They were very successful. And when they came to me, Tom was 62 and Sarah was 59, and they were about to sell. And it was the biggest single transaction of their lives. Most advisors would have jumped straight into products. You should buy this stock, you should buy this bond, maybe private equity. But that wasn't what mattered to them. What shaped that meeting was their vision. Sarah wanted flexibility. She wanted to have time with her grandchildren. She wanted the ability to travel without stress, freedom to choose how she spent her days. And Tom wanted to know that decades of 60-hour weeks would translate into a retirement without money stress. And then Tom leaned in and said the line I'll never forget. "Lisa doesn't want to be a landlord after I'm gone." That one sentence told me more than any financial statement ever could. It wasn't about chasing the highest return. It was about clarity, simplicity, and creating peace of mind for his wife. Here's what would have gone wrong if we'd missed that. They could have walked away with a lump sum. They could have reinvested it in real estate and spent the next 20 years managing properties. And those were properties that Sarah never really wanted to manage. Or maybe they might have piled into a portfolio of growth stocks and watched it swing wildly up and down, keeping them up at night. Instead, we designed everything around that purpose. The purpose of simplicity, of making things stress-free. So we created a seller finance deal with 15 years of guaranteed payments secured by the company's assets and backed by a personal guarantee of the buyer. We structured it at 7% interest, which was competitive but gave them predictability. They had income. We created a municipal bond portfolio for short-term liquidity needs. And then we put the rest into stocks to serve as inflation protected. We also timed the payments to keep them in the same tax bracket that they were used to. We're trying to avoid the mistake I see too often, where families trigger massive tax spikes by taking too much income at once. It wasn't the most aggressive return on paper, but every quarter, $180,000 arrives. They had no spreadsheets, no wondering what the markets will do, no late night calls about property management or toilets. They just had money showing up in their mailbox every single quarter. 6 months later, Tom said, "For the first time in roughly 25 years, I actually sleep through the night." And Sarah added, "We finally feel like we own our time again." You see, that's the point. When every dollar has a purpose, the portfolio stops being abstract. It becomes something that fits your life. And here's what happens with wealthy families. Once your wealth reaches the level where a single mistake can cost 6 figures, you stop asking, "What should I buy?" and you start asking, "What job should this money do for my family?" Because at this level, getting the purpose wrong is expensive in ways that go far beyond returns. Principle number 2 is efficiency before returns. When I was early in my career, I thought the best investors were the ones that got the biggest gains. But over the last 3 decades, I've learned the real winners are the families who master efficiency. Because at a certain level of wealth, what matters most isn't how much you make, it's how much you actually keep. And I see this all the time. Families who look wealthy on paper, but they feel stuck because any move means a huge tax bill. David was one of them. He was a developer with about $15 million in property. Some buildings he bought for $500,000 were worth $3 million now. It sounds great until he tried to diversify. You see, selling $5 million would have meant a $1.2 million tax bill. He looked at me and said, "It feels like the IRS has become my new business partner." And I see that same frustration every week. Doctors who own medical buildings they bought decades ago, families who bought vacation properties in the 90s that are now worth 10 times more, or business owners sitting on stock that's skyrocketed in value. On paper, they're wealthy, but moving a dollar means triggering a tax avalanche. When I was talking to David, this is the mistake that I actually underlined twice in my notes. Families assume that they're cornered, but they're not. With David, we moved the lowest basis properties into a charitable remainder trust. The CRT then sold them tax-free, gave David and his wife a 10% annual payout for life, and left the rest to causes that they cared about. So they got a tax deduction, they got guaranteed income, and oh, by the way, they didn't pay tax on the sale. So the mechanics matter here. Like I said, he got an immediate charitable deduction of about $800,000, which he could carry forward over 5 years. The trust generates about $150,000 annually for him and his wife. And when they're gone, the remainder funds go to a scholarship at their alma mater, something they'd want to do anyway. For properties with smaller gains, we used a 1031 exchange into what's called a Delaware statutory trust, which is basically institutional real estate that's diversified across markets and typically is professionally managed. It got him out of the landlord duties without triggering tax. These DSTs owned everything from medical office buildings to distribution centers, giving him exposure to real estate markets across the country without the headaches of direct ownership. And some properties we just simply held. His kids would inherit them with a step-up basis, and that would wipe out decades of embedded gains. We documented the strategies carefully, making sure the family understood which properties to never sell and which ones offered flexibility. 3 years later, David had diversified $8 million out of direct ownership. Instead of losing a couple $1 million to the IRS, his total tax outlay was under $200,000. David told me one time, "I thought I was stuck. Now I realize I had more options than I knew what to do with." And it didn't happen by chance. It happened because we built efficiency in before we ever talked about returns. And truly, this is a pattern that I see across families who've made it. They stop obsessing about beating the market by a percentage point, and they realize that avoiding unnecessary taxes creates more lasting value than chasing the latest hot investment. You see, once wealth reaches the point where taxes are your single largest expense, you can't afford to think about yield. Defense starts to matter as much as offense. And once efficiency is in place, there's one final piece that makes or breaks the whole plan, and that's coordination. So principle number 3 is that we need to have coordination before complexity. And this is where good plans quietly fall apart. On paper, many families look like they're in good hands. They have a strong CPA, they've got an estate lawyer, they've got an investment manager. But without coordination, those strengths, they can actually work against each other. I saw it with Janet. She was a widow in her 70s with about $18 million. She had all the right people, but they weren't actually talking to each other. Her CPA minimized taxes, her attorney focused on estate planning, her advisor pushed for higher returns. And those are all good goals, but no one was talking about how they fit together. And that's really how big mistakes creep in. For example, she had a $2 million life insurance policy, and it was drafted to sit inside a trust, but they never moved the ownership from her name into the trust. So on paper, it was still in her name, and that single oversight, if they hadn't moved it to the irrevocable trust, would have cost her kids $700,000 in estate tax. And so we actually moved the life insurance policy from her name into an irrevocable trust and saved her a ton of money in taxes. She was also paying capital gains personally on her investments inside her trust, even though the trust was set up to cover those taxes. And so that mistake cost her $40,000. And her charitable giving, it was generous, but structured in a way that actually increased her taxes instead of reducing them. You see, none of these problems came from bad professionals. They came from professionals that were working in silos, right? They weren't working together. And when I read through everything, I read her trust, I read her estate planning documents, her tax return. When I read all those things, is what we realized is her trust had been properly funded with most of her assets, but 3 accounts had been missed. Her attorney had drafted the insurance trust perfectly. It was a really good trust, but no one had actually transferred the assets and the policy into the trust. Her CPA was preparing returns based on incomplete information because he didn't have copies of all the trust documents. So we built a system, every document reviewed, every return, every K1, every policy checked, and most importantly, we pulled everyone to the same table. And here's the detail that really mattered. We created a calendar where her CPA, her attorney, and I reviewed every major move together before it got implemented. And in the first year alone, that simple habit prevented 3 more significantly costly errors. We also established what I call a paper trail protocol. Every change to any account, trust, or policy gets documented and shared with the entire team. It sounds kind of bureaucratic, right? But when you're dealing with big estates, the cost of confusion is measured in millions. And it actually changed more than just her balance sheet. For the first time in years, her family knew exactly who was responsible for keeping the big picture together. No more confusion about who to call, no more conflicting advice. And her daughter told me, Mom finally stopped worrying about whether she was doing the right thing because she knew there was someone watching the entire picture. And Janet later told me, for the first time since my husband died, I feel like someone actually understands our situation. And so the outcome is that her kids will inherit $1.3 million more. And that's great. An extra $1.3 million is super helpful. But what mattered most wasn't a single fix, it was the relief that comes from knowing that you have everything working together and that there's someone watching it. And you see, that's the lesson. Once your wealth reaches the stage where small oversights can translate into 7-figure mistakes, coordination makes the difference between money that lasts and money that quietly leaks away. Because it's not enough to do things right, you have to make sure everyone is doing the right things in the right order at the right time. So those are the 3 principles I see over and over with family who've built wealth. The first is purpose before products, efficiency before returns, and coordination before complexity. You notice what's not in there? No hot tips, no timing the market, no hedge fund secrets on an airplane. The truth is simpler and far more powerful. It's not about chasing shiny objects. It's making sure the money you've worked so hard to build actually supports the life you want, and it protects your family and that it lasts. Once your wealth is at the level where a single mistake can cost 6 figures or even 7, the game changes completely. The questions change, the priorities change, the stakes change. And if you're building serious wealth through a business, through real estate, through investing, you probably saw yourself in some of these stories. And if you'd like to go deeper into these, I post these videos all the time. And I really do love making them, and I hope you watch and subscribe. If you'd like to chat, there should be a link to my calendar below. Like I said, I love making these videos, and I hope to see you on the next one.